Hey guys, how you doing today? This is Riley of the Big Thinking Aussie. Hope you're all doing well. This is me coming back with another investment video. It's been a while, but now I'm here and I'm ready with some great content, so I hope you guys are keen for this. Basically, just a quick disclaimer. Everything I'm talking about in this video is purely my own research. It's not me trying to recommend you to buy something. This is definitely just putting my ideas out there for you guys to be inspired by, and also just kind of showing you how you should conduct your own research into stocks. But that being said, guys, this is going to be the finance wrap episode 2. We got a few things to talk about, and let's get into it. So the first thing we're going to talk about is Afterpay Touch, which is a massive kind of there's a lot of hype around it. It's a big kind of growing stock in the Aussie marketplace with a lot of investment from overseas as well. So basically there's been some big fluctuations this week. On Wednesday the 22nd of May it fell 2%. Today on the Thursday the 23rd it increased 2%. So I think that this kind of shows that when the market movements pulls the stock price down, the investors are there, they're waiting for it to drop, and it's gonna rebound with an upswing. There's strong demand and it shows an overall level of strength as a long-term position. But I'd say the fair value for Afterpay would be roughly 27 right now. But anything under $23, $24 probably be a buy, depending on how much capital gains you're after. Now, the reason for Afterpay's massive kind of rapid growth, I'd say, would mainly be their expansion into the UK. So they're already in the US market and they've moved successfully, and they're also diversifying from retail to health and tech and high-end goods. So one article I was reading about Afterpay Touch kind of we're talking about all the AU sort of tech stocks becoming like a bubble that would eventually have a big sell-off due to it's mainly a hype thing more than actual value. However, I still think that anything can happen overnight in the stock market. Don't get me wrong, it can all burst and start coming down, but I think if there is any negative fluctuations in share price, it will be quickly met with an upswing just due to the sheer demand. Afterpay is still in its growth stage, and you can see from this week that when the market did pull down on the share price, it quickly rebounded back up. So I wouldn't worry too much about it being a bubble. Afterpay still holds the greatest market share amongst its competitors, and it's still very much in its growth stage. It's still expanding, and one comment that I will make is that if you're trying to use your product for bigger transactions, because right now Afterpay is sort of just a product used you might buy a few pairs of jeans, you afterpay it, you pay it in 4 fortnightly installments, and they'll get 4% of the financing, because they'll pay the store straight up, and then you'll have to pay Afterpay without any fees that you're paying, but the store will give Afterpay 4% basically. So my point is that if you're trending towards bigger transactions like $500 plus, I feel like the 4% might not be big enough. Maybe you have to increase that over some value, because the repayment risk is definitely going to grow, especially if you're in other markets where it's a bit more unpredictable with the legal side of things. But I think Afterpay is going to grow in value over the next 10 years, as well as they're starting to give out dividends, so I think it's all going to keep going up for Afterpay, but could be wrong. That being said, a buy-in sub $25 is still probably a great price, so always consider Afterpay in your next investment choices. The next stock we're going to be talking about is Macquarie Bank. So it's a large cap blue chip bank stock. It's pretty doesn't have a lot of risk associated with it, but the one big thing is $120 a share. It's quite expensive. So you got to ask the question, why would I buy in at that price? the short answer, the share price has actually tripled in 3 years. So not tripled, doubled in 3 years. So it was $60 back in 2016. Now it's 120, and that's after a downswing, which I'll go into in a second. But I think the reason why Macquarie would be great for the long position is because following the Royal Commission, in which like the Big Four have been put under the pump for trying to resolve issues with investors, because they've sort of been like exposed, and I say that with quotation marks, because they've been charging dishonest fees and misrepresenting customers. Now, the reason I say exposed is because a lot of people are expecting the findings to be a lot worse, a lot more scathing, and a lot more, reputation damage would have been done to the Big Four banks. But the thing you need to understand is Macquarie is outside of the Big Four bank. It is pretty much the fifth top bank, kind of knocking on the door of those four. And as the other four will kind of have a close eye from regulators like APRA, and they're going to solve their remuneration issues and structural problems, which are probably going to hinder them into the next decade. Macquarie are kind of exempt from this because they only rely on retail banking services, because it accounts for 12% of their proceeds. So it's really they don't do a whole lot of deposits. They mainly focus on the M&A sort of side. So if you don't know what M&A is, it's sort of like investment banking. It's where you're acquiring other companies, you're picking up other companies, and benefiting from that. So you can make millions off these kind of deals, and I just think that they have a lot of strong they've got a really strong structure in which they're not going to fall victim to the same issues as the Big Four. And also the ex-dividend date just passed. So basically what this means is the ex-dividend date, there's a certain date every year or every 6 months, depending on how often stocks give dividends. But after this date, you're not entitled to the next dividend. So it makes sense that, say if it was yesterday, the stock price might drop right after, because if I invest the day after the ex-dividend, I'm not getting the next dividend, so I'm losing some money. So the stock price will drop basically by the percentage of the dividend. So the stock price this week has sort of remained around 120, which is about $10 to $15 less than I'd say a fair value would be for Macquarie. And also the banking industry is forecasted to have sort of a down year in 2020, but you got to consider that Macquarie's got very strong growth in earnings, very strong growth in PE, as well as dividend growth. So also this trade saga, Macquarie can kind of benefit off, because there's a lot of uncertainty. They can sort of go and acquire new businesses which are underperforming and aren't expecting to turn around. So Macquarie will come in and take their assets and synergies and benefit off that. But I think Macquarie will likely outperform the expectations of them and could be the most prosperous Australian bank over the next decade. I personally think so. The main issue with Macquarie obviously is their very high share price, but if you have a large amount of capital, maybe it's a good blue chip stock for you to feel safe about going into the next 10 years. So that's going to be it for the video, guys. I was going to talk about some other stocks, but I'm going to save that for another video. If you enjoyed today, leave a like, comment, subscribe to The Big Thing in Aussie, because it's really going to inspire me to do some more. I think I'm going to do maybe some ETF videos coming soon, so let me know if you're going to be keen for that. And yeah, that being said, guys, hope you all have a fabulous day. I'm going to go to uni now, and yeah, peace out. Have a good one.